Thanks a lot, everyone. Slight change in topic from NFTs and the metaverse and gaming, play to earn. We're going to talk about real money now. Asset management. I'm David Olsson. I'm the global head of distribution at BlockFi, a fintech and crypto financial services company. We have 900 employees around the world. Do more with your crypto, I guess, is our tagline. And then I'll let our honored guest here.
Hi, everyone. Ed Carlton. I run the digital institutional sales desk over at Flow Traders. Flow Traders is really known in the market as a technology-based liquidity provider. Really cut our teeth in the ETF space. Been around for some 17 years. But I'd say from kind of the last 5 years, really kind of carved out a nice niche for ourselves in the digital asset space. Arguably now the #1 guys to go to when it comes to liquidity for the crypto ETPs across the globe, and servicing liquidity for all of the digital assets.
So hello everybody, my name is Jean-Marc Bonnefous. I've been in asset management for the last 15, 20 years, mostly in commodities until recently we're launching under the brand Tellurian Exo-Alpha systematic crypto hedge fund. So yes, it's something that we feel quite familiar, having traded quite volatile assets in commodities. As you can see with natural gas, it's even more volatile than crypto.
Great, thanks guys. So first up, we'll start with you, Jean-Marc. If I'm a would-be hedge fund manager and I want to launch a crypto fund, what are the kinds of hurdles that I'll face in launching a fund that's obviously not traditional, and what are the considerations, would you say?
So the answer is pretty quick: don't do it. No, without joke, I think it's fair to say that there's been an institutionalization of that business. It used to be days where you could just say, you know, I'm a crypto hedge fund, you know, send me money. I think those days are long gone. Today, in order to have the hope to raise a significant amount of capital, you need to show due diligence, track record. Crucially, you need to have infrastructure that is robust and scalable, and you need to have the permissioning to be managing money, which is in the UK is the FCA approval. So all that adds up. Then you need to have your lawyers, your operations team, your administrator. So there's a cost element to it. And then once you've done that, obviously you need to find the right product mix, in a sense that there are a lot of long-only product available, mostly ETPs, and that's fine. But what a hedge fund does, it's there to create market insensitive performance called alpha, right? Whether a market goes up and down, you're supposed to make money. It's what we call a hedge fund. So it means it's a different type of strategy. And today, if you have probably $40 billion of investments of asset management in crypto, you probably only have maybe 4 billion in hedge funds. And out of the 4 billion hedge fund, you might have less than $1 billion in long-short alpha type of strategy. So you need to find the right product mix to gather the assets.
Right. Thanks, Jean-Marc. And I guess we'll get into some of the other considerations like service providers and things like that later, and we'll be interested to hear about some of your experiences on the road. But I guess next up, Ed, coming from a bit of a different perspective. Obviously, Jean-Marc, you're from the come from the alpha generating world. Ed, obviously one of the best liquidity providers or premier liquidity providers in the market in crypto, focusing a lot on passive products. You're very involved in the crypto ecosystem and regulation and market infrastructure. When are we going to see a proliferation of crypto passive products that people can invest in? And particularly, we're in London, there's no LSE listed passive ETF at the moment for crypto, which is amazing.
Yeah, it's a good question. And I'm not sure there's like a single answer that, you know, if you do A, then all of the, you know, the hordes of cash will flood into the market, or all of a sudden all of the markets will open up. I mean, a backdrop to to this is that there's not a shortage of issuers or products coming to market. I mean, off the top of my head, I think we're involved in something like 30 different products that were issued and listed in the last month alone. But there's definitely, as you mentioned, like LSC, there's certain pockets of investment, pockets where there aren't any products being issued. You know, a big focus on the US. And I think an overlying theme that I take from that is that at the moment the market is very fragmented in terms of geographical acceptance. A very strong example we can take is look at where the issuers are currently based in Europe, you know, in Switzerland, in Germany, and that's because the regulators, FINMA and BaFin, have been a bit more proactive, I believe, in accepting these products, working with the venues, so like, you know, Citra and SIX, you know, for Germany and Switzerland respectively, to allow these products to be listed. It may be that when we actually have some form of normalization, I mean, I don't know ever globally, but we could maybe look at something like MiCA for the European regulation, if it will then give us a kind of level playing field for Europe, that you know, the regulators, the venues such as the LSC, Borsa Italia, etc., can look at, and that should, I think, be quite encouraging for some issuers to come to the market. The only second thing I think is more down to our market infrastructure. Something that's mentioned time and time again. It's a very inefficient market at the moment. It's super capital inefficient without any form of credit intermediary, no prime brokers servicing this market. And you know, even from a custody standpoint, yes, that's come a long way in the last kind of 2, maybe 3 years, but we're still not, I think, at a certain point where, you know, the tier 1 issuers and asset managers of this world are comfortable necessarily bringing products to market and putting, you know, billions of dollars behind that.
Yeah, I totally second that. And to go back to the sell side, the hedge funds are really buy side, and the service providers are the sell side and the liquidity providers. There's clearly been a tremendous improvement on the market infrastructure and structure in terms of delivering pools of liquidity to hedge funds, right? Undoubtedly, and it's improving by the month. It's not quite perfect yet, as you rightly pointed. There is not really the classic PB, prime brokerage function available in crypto, where effectively you abstract away the credit risk because you have a large financial institution standing and taking the trade for you and MDFing you if the exchange or the counterparty defaults. So that's not quite there. There are signs of life. They could be a lot of well-funded non-bank financials are working on this, but the banks, crucially, are not bringing into the crypto arena what they bring to hedge fund asset management in fixed income, equity, commodities, which is the PB function, right? So that's a big miss. However, in terms of pools of liquidity, it's quite impressive how long we've gone, knowing that a typical hedge fund in crypto will not trade much of the actual cash, but you will trade a lot of the derivative. So particularly if it's a systematic hedge fund that churns a lot of volume. Obviously we have this kind of regulatory gap still in the missing in terms of a very clear regulatory framework for derivatives in crypto, which you have to do a few twists and turns to be able to provide the liquidity. But when it's all said and done, I think it's fair to say today you can really scale a hedge fund type product in crypto, and you were not able to do that, I would say, two years ago. So that's tremendous improvement.
Yeah, really interesting. I think that I'll get in a small plug here. We launched our BlockFi Prime product in May. The reason why we launched it was because our clients came to us and said, actually, we need your capital. Can you roll out something that how we can access the markets without having the friction, obviously, where if you want to trade, you have to put assets on exchange. And then there's all through the settlement cycle, there's capital requirements. So that was really to meet our client demand and something that we're still working on, obviously. Next up, how do you think investors can get comfortable with an asset class that has such high volatility? I think that's one of the things that we get a lot of pushback. We do a lot of evangelizing for crypto to traditional firms, trillion-dollar plus asset managers. That's kind of what part of what we do at BlockFi on the institutional side is a lot of education, and they ask a lot about the volatility and how can we sell this to our investment committee?
That's a really good point, because I think that's crucial in scaling crypto for institutional investors. A large allocator investing into a hedge fund, which is the highest risk asset, the highest kind of volatility you can find in a large allocator portfolio, will not invest into a product, a hedge fund, that has more than 5 to 10% maximum drawdown in 1 month, right? And then you look at the crypto market, right? Maximum drawdown routinely 20 to 30%. So that's the equation. And the way to solve it, the way we're solving it, and a lot of other hedge fund professionals are solving it, is to basically insert shorts in the mix, right? Because the only way to basically, you can either deleverage to the max, but then you have money wasted away, sitting on an account, or you are full leverage, 100% leverage, meaning you have one-to-one leverage, but then you have shorts that allow you to do controlled drawdown to meet the criteria of a large allocator, which is, again, you're not going to tick the box and get on the list of a large bank for hedge funds if you're more than 10%. So that's basically why we need that infrastructure, prime brokerage, all those services to be able to synthetically create those shorts at a efficient capital cost, and not being kind of, it has to be that settlement. So it's all about this value chain of trading, settlement, margin, to be able to create that synthetic short in a portfolio. For the hedge fund, again, because it doesn't apply to ETPs and long products.
I mean, my only thing I'd probably add to that is I get a bit sick of the, volatility calls. I don't think there's a problem to be solved here. We're a prop shop. We love volatility. People trade VIX for fun. And look at some of the commodities out there. A lot of the time we'd say, look, historically, look at some of the commodities. Let's look to our near past. Look at natural gas. It's like the volatility we're seeing in some of these commodities. They're no really different comparing realized and actual volatility. So it comes down to education. As long as you know and you're happy within the tolerances of the volatility of the asset class, that shouldn't be a problem. Volatility isn't necessarily a negative thing. There are products, there are derivatives out there which you can help manage those positions with. The options market should help round some of that off as well. I'm not really a buyer of this solve the volatility problem. Why is it a problem? Sorry.
I think if you do a taxonomy of the investor, you can fit that all together, because the retail investor is okay with volatility, right? So no problem. You can go beta, long only, no problem. You can take the 20%, 30% because it's going to a million, right? It's going to a million, right? So now the family office is a little bit more conservative, right? Because they have to protect the family money, right? So they might want to have some mitigants in and not go full. So they might have some long only position, and then they will add an overlay with a more controlled volatility product, right? And this is what's happening in every other asset. You first start with a beta, meaning full risk up and down on the asset, and then you add alpha products. And I believe we're in the early stage of that product range movement, where you go up the curve to the institutional, because the institutional then will have much more stricter volatility requirements. And so it depends really which kind of use case you have and which kind of ultimate investor you want in your product. So you need a barbell approach with different product for different investors.
Great. I think next question. What are you most excited about in what's happening in crypto right now, or what are you most excited about in terms of the future?
I think my answer is probably not going to be one that would fly well with this audience because I probably have a slightly different view. Mine's more around like market infrastructure, which is like mind-numbingly boring. I'm generally very excited to see some of the developments we're seeing with the market infrastructure around prime brokers, around people actually putting their minds, capital to work to try and solve the problem. Like, we're aware that, as I've mentioned before, it's very capital efficient. We have this problem around managing credit. And for me, when we solve that problem, like, that's really when the market's going to fly. That taking a step back and try and say something a bit more insightful, I think the other thing that does excite me is the fact that we are kind of on this point of inflection. We're really, really early days. I mean, people are looking at like the SEC and what's happening with Bitcoin futures. You look at some of the asset managers coming, and we really are still on the tip of the iceberg here, and that's what's really exciting. When products like a physical ETF gets launched in the US, when LSE lists something in Europe, when we have prime brokers, that's when the capital inflow is really going to be at its most. And we're going to see, in my view, 3-5 year bull run kind of off the back of that alone, and that's what's going to be exciting.
Yeah, if I had a wish list, I had some small improvements and some big picture kind of wishes. I mean, the small improvement, again, if someone here, and David, you can bring PB, prime brokerage, to the equation, then we can bring more institutional money into the pot, and everybody will benefit from it, right? So that sounds like a small point, but it's major if you're in asset management. Then I think the other more generally trend that I find very exciting is the confluence, the convergence of TradFi and DeFi. I mean, DeFi is a phenomenal exercise of style, but it's limited to what's in the ecosystem, right? If you can bring some of the TradFi assets into DeFi with the right bridge and the right framework, whatever it is, I know it's not easy, then you have a phenomenal hybrid model that can scale. And that space, to me, is very exciting. And the third last point, to go back to asset management, is the emergence of this concept of VC accelerators on L1 blockchains, where you can now have some kind of DAOs, community-activated investment vehicle, that is where the community votes for projects on L1 blockchains, and that are funded by the community, and then they accrue to the community by having a token being given back as incentive. So that's a very exciting space for, I think, the next couple of years also.
Yeah, totally agree. And hopefully what I'm excited about, building that roadmap and building, as you mentioned, basically the backbone of investment management. We have a flight path in terms of going through the different products that you see in traditional assets, whether it's synthetic, prime broker, physical prime brokerage, synthetic prime brokerage, derivatives, and then going through those products, but making them much more scalable than in the traditional world, and then actually seeing basically the small fish eat the big fish at the end of the day. I don't know whether that's going to happen in a year, but it'll happen in the next couple of years. I'm convinced of it. Well, I think this has been fantastic. Thank you both very much. This is a lightning round, so very, very quick, but speakers are around if you want to chat. Thanks very much.